If you start doing this young enough, you are guaranteed to become a multi-millionaire. Guaranteed. It's nailed on. Just listen to what I've got to say here.
So I would go as far as to say there have been two huge pivotal choices in my life that I've made that have affected my life in a huge way and benefited me. A, giving up drinking. B, teaching myself how to invest.
Now, everybody's worked really hard to build up their window cleaning business. The window cleaning business is becoming established. You've got, let's say, a couple of £1,000 worth of work a month that you've built up now through hard work. You've got your social media platforms up and running. You've got your website. You've got your flyers, and work is coming in now. So what do you do with the money, right? There's no point in working really hard if you're not going to do something with the money. Now, what you've got to do is create wealth. And the only way that you can create wealth, which is virtually guaranteed, is by investing a percentage of your profits. Now, the ideal percentage to invest is around 10%, but as long as you're putting a chunk of your profits into investments, that's what we're talking about here.
You're going to need an online brokerage site. Now, I use Hargreaves Lansdown. I used Hargreaves Lansdown because it was recommended by Martin Lewis, the money saving expert. And I find the site really easy to navigate. The app is fantastic to use, and the support system is really good.
And it's all about what they call dollar cost averaging. It's investing money every month, you know, and with the ISAs, the SIPs, the fund and share account, what you can do is you can set it all up so it's automated. So you get a direct debit from your bank account that will take the figure of your choice, dump it into your Hargreaves Lansdown account as cash, and then once a month Hargreaves Lansdown will invest that into the fund of your choice. So you don't even have to think about it, it's just done. Now, the investment journey, I got into the investment journey only 4 years ago. My dad died and I stepped in and sorted out all my father's finances for my mum, pensions, things like that. And that made me take a long, hard look at how much we were getting ripped off by so-called financial advisors, fund managers, pension providers. The finance world, the financial management world is a real minefield. And as I said, we get taken advantage of because most people, I was one of them, you know, years ago when I bought my first property in like the mid to late 80s, you sign up and you start a pension. You get a financial advisor that comes around your house, talks you into doing a certain product that he's going to get a massive commission on, and so you set up that pension fund and you run with that forever, right? That doesn't have to be like that now. What I did is, from that moment in time, I knuckled down and I spent 2 years reading books, watching YouTube videos, listening to audio books, and I just threw myself into the world of finance and investment for 2 years. Just completely immersed myself in it. So after 2 years of research, I decided that I'd built up enough knowledge and I'd built up the confidence to do something about my SIP, self-invested personal pension. So I transferred my SIP, and I'm not going to name and shame the company, but they were shit. I transferred my SIP. It took about 4 weeks, and I opened up a Hargreaves Lansdown account and I transferred the whole lump, my whole life savings, because I'd been divorced twice. I'd remarried for a third time. So it was a big gamble. I mean, I literally transferred all of my life savings because my second marriage, when that failed, I walked away with a bag of clothes, lived in a caravan for 2 years and went again, buying out other window cleaning businesses to make the maintenance payments and just to grow the business and try to make another life. So this was a big move for me. This was my whole life savings. I transferred from this SIP, I lumped it into my newly opened Hargreaves Lansdowne account. And I first started messing around with, I opened up a fund and share account. And I just was I won about 180 quid on the lottery. And so I literally was messing around. I'd read some books and I was individual trading. I was doing individual stock I was buying, which you don't want to do, incidentally. Index funds is where it is, but we'll get back to that. So I was looking at how things worked and watching them for a few months. I got a couple of index funds, put some money into them and watched that over a period of time and learned how it all worked and learned how to manage a Hargreaves Lansdowne account and learn how to manage a fund and share account. Now, a fund and share account, basically, there's thousands of you can invest in any type of fund or share. You can buy any type of stock or fund within a fund and share account, and you pay capital gain tax on the profit that the investment makes over time. So by this point, I thought, right, now I've watched how things are performing and I know where I want to put my money. So I then transferred that money into a SIP. So it'd gone from one SIP that was underperforming and I was being ripped off with ridiculous charges, because what you do is when your pension provider will try to beat the market. So he'll have a fund manager. Okay, you can't ever beat the market. They might get lucky once or twice, but it can't do it consistently. But they're charging you for attempting to beat that market. So that's what racks your charges up at the end of the year. And those charges, you imagine that the fund manager is charging you, your pension provider is charging you all those charges over 40 or 50 years. So you can just imagine how that's going to affect your pension pot at the end of 50 years, because investments rely on what's called compound interest. Now, if you've got that amount of money a year, I think I was paying about £1,500 a year in management costs over 40-50 years. That's colossal. Now with the Hargreaves Lansdowne SIP, it cost me £230 a year to manage it. So I've now taken my SIP from my pension provider that's been there forever, charging me the earth to manage it, and I've popped it into my SIP that I'd created within my newly opened Hargreaves Lansdowne account. And I knew where I wanted that money invested within my SIP. So I chose VUAG, that's the ticker code for it. So basically my whole life savings I threw into an index fund, a Vanguard ETF index fund in the S&P 500. Now, a very long story short, that was 2 years ago. So 2 years swatting up. It all happened 4 years ago. 2 years swatting up and learning everything I could and soaking up all the information I could gain on investing, wealth management, etc., etc. I've popped it from my pension provider into my SIP in Hargreaves Lansdowne. 2 years later, I've had a 40% return on investment. Okay, now that will go down. What happens is you get what's called market corrections. They're really quite regular, and that's when the S&P 500 will dip by about as much as 10%. That happens about every 2 years. About every 2 years, a market correction by about 10%. Then it's back up again. It doesn't last long. Okay, you get stock market crashes. Okay, now that's when it can drop by 20-30% and more. Now that happens about every 7 to 8 years, and they normally last about a year or so. Bull market that we're in now, which is when the stock market prices can rise by 20% and more. Now that happens every 6 years, and a stock market bull run can last for 6 years. When you do get a crash, that's the time to up the amount that you're buying in. So your direct debit that goes into Hargreaves Lansdown of cash and then gets invested, okay, when the market crashes, that's when you need to up that figure that you're getting transferred and investing with, because then in a year or so, when the market picks up, you've got all that stock that you've bought in the market correction or the crash at low prices is now compounded. And that's how it works over time, over 30, 40, 50 years. That's how you make your money. If you look at the graph that I've put on here, since about 1920, the S&P 500 has averaged about 10.64% over the last 100 years. So the graph is up like this. You know, you get your peaks and troughs, like I've just said. You get your market corrections every 2 years. You'll get a stock market crash every 7 years. But then it comes back a year later and it goes up 20% more than it was previously. So it's constantly over time. That's what you've got to look at. You've got to look at history and what a market does over time. And that's what I spent a couple of years doing. Look at history and look at what it's done over the last 100 years. That gave me the confidence to do what I did. Take my life savings from there, put it there, and it's flying. And like I've said, it'll dip, then it'll come back and it'll start flying again. Now, those SIPs are purely for retirement. Now, you can't touch those until you're 55. And when you're 55, you can take a 25% lump sum, and that's tax-free. And then any other drawdown you take from then is taxable at source. Hargreaves Lansdown, I take a monthly drawdown now because I'm 61 now, but I started when I was 55. I took the lump sum and I take a monthly drawdown, and Hargreaves Lansdown tax me 20% at source, so you don't have to worry about all that's done for you. Now, the fund and share account, as I've previously explained, that you pay tax on the capital gains, how much the investments have made over time. Now, another one that's fantastic, there's three vehicles, I call them finance vehicles, where you can put your money. There's, you know, within Hargreaves Lansdown, the main ones, SIP, ISA, and a fund and share account. ISAs are absolutely fantastic. They're tax-free, but there's a limit on how much you can invest a year, which is £20,000, which, to be honest, is a cracking sum. I mean, it's £1,600 a month, and I'll spark up on the calculator in a minute, the compound interest calculator, and show you just how much in 40 years £1,600 a month would equate to with compound interest. Now, this is an astonishing example of compound interest. The S&P 500 over the past 100 years has averaged a return of 10.74%. So let's assume a return of 10% there. Over 40 years, investing £1,600 a month, £10.2 million. Astonishing. Now, a fund and share account is unlimited. You can literally throw millions in there every year if you wanted. But the difference between a stocks and shares ISA and a fund and share account is an ISA you're limited to invest in £20,000 a year. But it's tax free, which is absolutely fantastic. So you put your money into the ISA, and when it's inside that ISA, you can invest it wherever you want, in any company, any index fund, whatever you like. So, I mean, again, you know, the S&P 500, you've got to look at the historical returns of the S&P 500 over the last 100 years, you know, 10.64% average return on investment over the last 100 years. You know, I mean, that was enough for me to learn about the S&P 500 for me to say, yep, that's it, that's where the money's got to go. That's where the money's got to go. So when you're working so hard to build up your window cleaning business, you're generating a profit now, you've got to start investing a percentage of that profit to be able to achieve financial freedom. Now, you guys are what? You're going to be late teens, early 20s, the younger, it's never too late to start, as I've proved, but you guys that are young, oh my word, you've got all those years ahead of you for those investments to compound. And I'll spark up some figures for you in a second on the compound interest calculator. Now, let's assume that you've generated a £2,000 a month profit with your business. So you invest 10% of that. So you invest £200 a month into the S&P 500 over 40 years. Now, if you look at the compound interest calculator here.
Now, using the compound interest calculator here, I'm calculating the compound interest achieved with the £200 a month, which would be the 10% invested of your £2,000 a month turnover that you've now got. And look at that, what a fantastic sum to have at the end of that 40 years. The power of compound interest.
It equates to around £1.2 million. It will compound to. And look at the compound interest. Look at the interest achieved. That's at £200 a month. And you imagine that's going to be nothing in 10, 20 years. You'll be putting treble that in. So that 1.2 million is going to be you'd be a multi-millionaire with 40 years of compounding ahead of you. It surely makes sense. The younger you can start on the investment journey, you are guaranteed success. It's guaranteed. Now, the S&P 500 index funds, your money, when you invest into the S&P 500, it gets divvied up between, I think it's 506 of the most successful companies in the US that are based in the US. Okay, so your money is going into and being invested in all the big players. And over time, what you're trying to achieve is financial freedom. And how you do that is you want to create what's called passive income streams. Now, an index fund is exactly that. Basically, it earns money while you sleep. You set it all up, it's automated, the money goes from your account into Hargreaves Lansdown, then once a month gets invested into your ISA, into the S&P 500, it's all automated, and it earns money while you sleep. There's no work needed. Nothing's needed, is it? You don't do anything. You don't have to get up and go to work. It's all set up. It couldn't be easier. Over 40 years or so, probably more, that investment is growing and growing and growing and compounding. What you're trying to achieve is financial freedom, and you achieve financial freedom when you get to the point where you can draw a monthly drawdown from your index fund that replaces your income, so you don't have to work, and it's not affecting the lump sum that you've got invested. So that lump sum is still growing, but you're taking out a lump sum every month to replace your income. So you're living off of that. You're living off of the monthly drawdown from your index fund, and your index fund is so large that it's not depleting in any way. It's still growing. The compound interest is still growing on that lump. So if you had like £1 million, you could take out 5%, 50 grand a year, and still maintain growth because it's growing at 10.64% average. So your pot is still growing and you're taking 50 grand plus a year out. That's what you're trying to achieve with an index fund. You buy it, you have it forever, you just keep it compounding, let it grow, and then eventually it gets to the stage where you can live off of it. That's what you're trying to achieve. What happens is your index fund becomes a cash cow. It just keeps giving and giving and growing at the same time. It's a fantastic situation to be in, and starting as young as you guys are is easily achievable. You just got to get it all set up, all automated, and watch it fly. Just buy and hold, forget about it, let it grow. I mean, I'm so thankful that when I was a youngster, I had the right work ethic and started businesses young, and then started buying property young, so it forced my hand into getting a pension, you know. But I only wish I would have known 40 years ago what I know now about compound interest and the S&P 500, because I wouldn't have messed around with an independent financial advisor or a pension company, pension provider. I would have just gone and done it all myself like I do it now. So what are you waiting for, guys? Get in there. There's some fantastic books that I recommend. The Simple Path to Wealth by J.L. Collins. And another great book that I recommend is The Little Book of Common Sense Investing, written by John Bogle, the creator of Vanguard. He created the very first S&P 500 index fund in the mid-70s, about 1975, 76. Awesome book. That explains it all. That'll explain it for you. Get it all on audiobooks now. So much easier. Pop it on in your van and learn all about index funds. So I would advise you to carry out your own research, do your own due diligence, get on YouTube. There's two YouTubers that I recommend for finance and investing, and that is Mark Tilbury and Toby Newback. Fantastic guys, really cool guys, and really know their stuff. Also, when you're reading your books, listening to audiobooks, watching YouTube channels, another useful addition is getting a copy of that. Get a copy of the Financial Times. I probably buy one a week. Sometimes I get the weekend one because they've got magazines and all that and lots of other stuff in there, not just about money. But I get a Financial Times probably once, sometimes twice a week. Just have a brief skip through it, and you know, sometimes you'll pick up some useful nuggets of information in there. So when you're doing your research and reading and watching your videos, get yourself a Financial Times as well, and get used to looking at the figures and seeing the markets and checking how things work. Anyway, I've got to get out this van. It is 38 degrees in here. I am sweating my nuts off. Thank you for listening. See you next time. Bully out.